Hi, I'm Amanda Martinez.
Hi, I'm Scott Schilke.
Hi, I'm Kelsey Marvin.
Hi, I'm Glenn Stratton, and this is the stock market.
While we already may know about the stock market in general, it is important to know about positive and negative events from the past. Let's begin with John Law.
John Law was vital to the financial world. To many, he was known as a financial genius, and to others, he was to blame for the downfall of France's financial system in 1720. John Law was born to a family of bankers and has always been fascinated with the stock market. Throughout his years, Law has dabbled in a number of business ventures and gambling antics. Law was mostly fascinated with how the stock market worked. He was especially interested when the Dutch started to issue receipts for any coins deposited into the bank. This sparked the idea of paper money in 1705. At this time, Law submitted a proposal for a new bank that would issue notes instead of coins. The Dutch did not approve of his plan, and he decided to go to Italy and try his proposal there. Again, his proposal was rejected, but was finally approved in France. France's financial system was a disaster, and they were hoping that Law's proposal would turn their financial system around. In 1716, Law opened the general bank where paper money would be issued in place of gold and silver. This system was great. The French had started to see their financial system turn around. There were two companies that were impacted by Law, the Dutch East India Company and the Company of the West. They soon formed a merger and became known as the Mississippi Company. This company flourished as many investors were investing in this company. The Mississippi Company shares values were increasing at a rapid rate, and in 1720, Law had felt that these company shares were overvalued and decided to devalue them himself. Protests had broken out because of this devaluation, and people were starting to see that their banknotes were becoming worthless. When people start to not believe in their paper money they are holding, that is when the real problem begins. Law tried to fix the problem by printing more money. He then caused hyperinflation for France. Many people started to get nervous and went to the bank and demanded their gold and silver back. Law was furious that he banned the export and production of gold and silver. Inflation overtook the country, and many people lost their fortunes. Thus, the Mississippi bubble had bursted, and the general bank could not recover from the damage Law had done and closed its doors in early 1721. Now let's look at an event that happened at the same time as the Mississippi bubble.
The South Sea Bubble was created by the South Sea Company in 1720. The South Sea Company was a British joint stock company founded in 1711. It was created as a public-private partnership to reduce the cost of national debt. They controlled the monopoly over South America, over trade, and actually no realistic prospect that trade would actually exist and any significant profit would be reached. By doing this, though, company stock prices rose greatly. Share price had risen to £128 in January of 1720, £175 in February, £330 in March, and £550 in May. It peaked around £1,000 in the midsummer of 1720 and collapsed back to the flotation price of £200. Several people were ruined by the collapse, and the national economy greatly reduced. Founders of the scheme engaged in insider trading. There was advanced knowledge of when national debt was to be consolidated to make a large profit from purchasing debt in advance. Huge bribes were given to politicians to support the act that allowed the scheme to take place. Company money was being used to deal in its own shares. Individuals used loans backed by shares to purchase more shares, and this led to the bubble. There was no actual profit from the company, except for poor managed slave trade profits. Several politicians were disgraced, and those that earned unlawful profits had assets stripped proportionate from those gains. This reinforced the Bubble Act, which means a company cannot create a joint stock company without royal charter, meaning backed by the monarchy. And this is actually promoted by the South Sea Company to push away competition from using the same scheme in making profit. Let's go later down in history to another stock market crisis with the Great Depression.
The Great Depression was another pivotal point in history for the world, particularly in the United States. It was the stock market crash of 1929 that everyone recalls. On October 24th, 1929, what is known as Black Thursday, the market opened at 305.85 and went as low as 272.32. This fluctuation caused a scare, and the days following were fearful. Richard Whitney, the vice president of the New York Stock Exchange, got together with several banking officials and made a bid for U.S. steel that stabilized the nation for a little while. On the following week, October 28, 1929, what is known as Black Monday, panic set in. Richard Whitney did not make another statement after his meeting with bank officials. Investors assumed they decided to sell. Richard Whitney was considered a hero just 4 days earlier, but now his lack of actions increased the trading volume. On Black Monday, trading volumes were at 9,213,000 shares. After several months, it did not get any better. The U.S. stock market lost over 80% of its value. Should the country have predicted a depression? In the 1920s, President Calvin Coolidge said the economy was full of optimism and promise. The radio, electricity, and motor cars were all creating a more technological nation, and everything was becoming more streamlined. It seemed as though the market could only go up, and the stock market was working well and providing economic value. But during this time period, there were also several things the country was doing to hurt the economy. As the world went off the gold standard, the United States stayed on until 1971. The Federal Reserve supported this decision and raised interest rates. This monetary policy increased the downfall in the U.S., and about 1/3 of banks failed. The monetary policy hurt people in the nation and created the need for Social Security. President Franklin Roosevelt created Social Security on August 14, 1935, in the hopes of protecting citizens from unemployment, old age, poverty, health issues, and disabilities. As you can see, with the creation of temporary assistance and the declining stock market, the 1930s were a difficult time for the nation. Let's take a look at a more recent event, the Enron scandal.
Enron was a natural gas company that was created by Ken Lay in 1985. Enron was created through the merging of two companies, Houston Natural Gas, who Ken Lay originally worked for, and Internorth. With the merging of the two companies that created Enron, the company was able to have a significant competitive advantage over their own competitors. Enron took part in mark-to-market accounting practices. With these principles, once a long-term contract was signed, the present value of the future inflows were recognized as revenues, and the present value of expected costs were expensed. Unrealized gains and losses in the market value of long-term contracts that were not hedged were then required to be reported later as part of annual earnings when they occurred. It seems that these principles were the start of Enron's downfall. This kind of accounting can lead to a company to record big gains in one period, but then significant losses in another period. It could also be that Enron's mark-to-market accounting led to showing very high gains rather than losses each and every quarter in the late 1990s. However, this way of accounting could have been just the starting peg into Enron's pegboard of financial problems. Along with Enron using the wrong kind of accounting principles, they were also misstating their financials. On most of Enron's financial statements, they never record special purpose entities, or SPEs. With these SPEs hiding Enron's total debt and losses from such things as projects and investments, it is safe to say that investors within the market had no clue that the company was actually losing money. Without these being entered into Enron's financial statements, then the company would have seemed to be more highly profitable than they actually were. Not reporting the SPEs caused the company's note receivable assets and shareholders' equity to be overstated by $828 million. Another example of misstating their financials is that in 1997, Enron stated that their net income was $105 million. However, this was not the case. Later down the road, it came out that their net income for that year was actually only $9 million, creating a $96 million difference. It is clear that Enron was guilty of fraud. By the company overstating their financials, they were able to convince investors they were highly profitable and could possibly attract more customers with their high profitability. These misstatements led to Enron to become the fourth largest company in the U.S. in 2000. However, that quickly changed. Enron was investigated for the misstatements of their financials, leading to the downfall of their company. When Enron was first being investigated, the company's stock price was almost $100 per share. However, once word got out that they were being investigated, it dropped down to $40 per share, and then eventually to 30 cents per share when they filed for bankruptcy. Enron never recovered. As for Ken Lay, he was also convicted on many counts of fraud. However, he suddenly died while appealing his charges. Because of his death during the appeals process, he went down as never being a convicted felon. While Enron was largely at fault for their practices of misstating their financials, Arthur Andersen was also responsible as well. Arthur Andersen was the company that Enron had hired to perform the company's accounting principles and look over Enron's financials. Rather than stop Enron from misstating their financial statements, it seems that Arthur Andersen supported it. As being the accounting partner with Enron, Arthur Andersen should have fulfilled their moral practices and reported accurate financial reports. Instead, it seems that Arthur Andersen supported Enron's misstatements and continued to go with Enron's flows and ideas. Because of these actions, not only did Enron fall into shambles, but Arthur Andersen did as well. Now that we know about the past events of the stock market, let's further explore the predictability and future of the stock market.
So Glenn, how hard is it to predict the stock market?
The stock market's very hard to predict. Things can go wrong in just a blink of an eye. The stock market has always fluctuated throughout time, and it pretty much fluctuates with how the economy performs. So as you can see, it is very hard to predict the stock market.
And how do you think it'll perform over the next 20 years?
It's very hard to say how it'll perform in the next 20 years, let alone the next year. While you may be able to use your best estimations based on prior history of the stock market, your estimations will not be fully accurate. So as you can see, it can be very difficult to tell what's even going to happen in the next 20 years.
Okay.
Amanda, what future innovations do you see coming to the stock market?
Well, in the next 20 years, I feel that we're going to completely move to electronic trading. I mean, we do have some floor trading on today, but we also do have some program trading. But I feel like we're going to move towards just program trading. It's easier to trade because you get to do it at a click of a button, and you don't have to go to the floor and trade.
Oh, that's interesting.
Mm-hmm.
So, as you can see, there are both positives and negatives within the stock market throughout time. John Law, the South Sea Bubble, the Great Depression, and the Enron scandal are just 4 great examples that show what can go right and both what can go wrong within the stock market. Thank you guys for listening. Do you guys have any questions?